With John AG here. Gold is holding above $5,000 for the second consecutive session, and I need to walk you through exactly what is happening right now, because the picture is becoming clearer by the hour. The dollar just fell to its lowest level since February 4th. That is not a small move. That is a significant breakdown in the world's reserve currency. And when the dollar breaks down, gold and silver catch a bid. That is the correlation we are watching play out in real time. Gold is trading at $5,004.61 per ounce right now, up 0.9% on the session after climbing 4% on Friday. Silver is up 3.7% to $80.89. This is the second consecutive day of strong gains for both metals. The momentum has shifted, the sellers are exhausted, and the buyers are stepping back in. Before we dive deeper into the data, I want to hear from you. Drop a comment below and tell me where you are watching from right now. Are you in Ireland, where this data just came across? Are you in the UK, Europe, the US, waiting for your markets to open? Asia, Australia? I want to know where this community spans. Drop your location in the comments, along with John AG, so I can see who is engaging with this content. This community is global, and I want to hear from every corner of it. Now let me give you the full picture of what happened overnight and what it means for the week ahead. The US dollar index touched its lowest level since February 4th. That is a significant technical breakdown. When the dollar weakens, commodities priced in dollars become cheaper for overseas buyers. That is basic economics. A weaker dollar means foreign investors can buy more gold and silver with their local currencies. And that is exactly what is happening right now. Kelvin Wong, senior market analyst at Oanda, pointed out that this is the very short-term intraday correlation between the dollar and silver, as well as gold driving the metals higher. The dollar weakness is providing direct support to precious metals prices. But there is more to this move than just currency dynamics. Japan just had an election over the weekend. Prime Minister Sanai Takaichi swept to victory on Sunday, and following that result, the yen strengthened significantly. A stronger yen means a weaker dollar on a relative basis. Currency markets are interconnected, and what happens in Tokyo affects what happens in New York and London and everywhere else. The Japanese election result is contributing to the dollar weakness we are seeing right now. And that dollar weakness is lifting gold and silver. Now here is something else that is driving this move. Bargain hunting. KCM chief analyst Tim Waterer said it directly. Bargain hunting is pushing gold back above the 5,000 level. After last week's volatility, after the sharp pullback from the highs, value buyers are stepping in. They see gold below 5,000, and they see an opportunity. They see silver in the low 80s after it hit an all-time high of $121.64 on January 29th, and they see an opportunity. The smart money is not panicking. The smart money is buying. That is what bargain hunting means. Experienced investors with long-time horizons are accumulating at these levels because they understand the fundamental thesis has not changed. Let me ask you something. For those of you who have been watching this channel for a while, are you seeing what I am seeing? The same names keep coming up. China buying, India buying, dealers struggling to source physical metal, and now bargain hunters stepping in after every pullback. This is not the behavior of a market that is topping out. This is the behavior of a bull market that is building a base for the next leg higher. Drop a comment and let me know if you agree or if you see it differently. I want to hear both perspectives because that is how we all get smarter. Now let me talk about what everyone is watching this week. The economic data calendar is loaded. We have the monthly report on U.S. employment coming. We have consumer price data coming. These are the two most important data points for the Federal Reserve's interest rate decision-making. And right now, the market is pricing in at least 225 basis point rate cuts in 2026, with the first one expected in June. That is the baseline expectation. But here's the thing. If the jobs data comes in soft, if employment shows real weakness, that timeline could accelerate. And if the timeline accelerates, gold and silver benefit. Tim Waterer put it perfectly. Any softness in the jobs data could help gold's rebound efforts. We are not expecting a rate cut from the Fed until mid-year, unless the jobs data really starts to drop off a cliff. That is the key phrase. Unless the jobs data drops off a cliff. If we see a significant miss on the employment report, if the labor market shows real deterioration, the Fed will have to respond. They will have to cut rates faster than currently expected. And rate cuts are bullish for precious metals because gold is a non-yielding asset. When interest rates fall, the opportunity cost of holding gold falls too. That makes gold more attractive relative to bonds and other yield-bearing instruments. San Francisco Federal Reserve President Mary Daly reinforced this view on Friday. She said she thinks one or two more interest rate cuts may be needed to counteract weakness in the labor market. That is a Fed official explicitly saying more cuts are coming, not might come, are needed. The Fed sees weakness in the labor market, and they are preparing to respond. This is the macro backdrop that is supporting gold and silver right now. Central bank policy is shifting toward accommodation. And when policy shifts toward accommodation, precious metals benefit. History is very clear on this relationship. Now I want to talk about silver specifically because the technical picture is getting very interesting. Silver just attracted strong follow-through, buying for the second consecutive day. That is significant. After hitting a low of $64 on December 17th, silver has recovered to just below $82. That is a massive move off the lows. And from a technical perspective, silver just broke out above the 23.6% Fibonacci retracement level of the recent sharp pullback from the all-time high. That breakout favors the bulls. When you get a breakout above a key Fibonacci level and it holds, that signals buyers are in control. The MACD, which is the moving average convergence divergence indicator, stands in positive territory right now. The MACD line is above the signal line. The histogram is widening positive. That suggests strengthening upside momentum. This is not a dead cat bounce. This is real buying pressure showing up in the technical indicators. The RSI, which is the relative strength index, is at 50.63. That is neutral territory, not overbought, not oversold. There is room for silver to run higher without triggering overbought conditions that might cause a pullback. But here's where it gets interesting. Any further strength in silver is likely to confront stiff resistance near the 86.25 to 86.30 zone. That is a confluence zone. It is where the 200-period simple moving average on the 4-hour chart meets the 38.2% Fibonacci retracement level. When you have multiple technical indicators converging at the same price level, that creates a significant resistance zone. Silver bulls need to watch this level closely. If silver can break above 86.30 and hold, that opens the door for a move toward the 50% retracement at 92.95. But if silver gets rejected at that confluence zone, we could see another pullback. Kelvin Wong at Oanda was very clear about this. Unless silver is able to clear above that key resistance at 92.24, he is not convinced in terms of a probability perspective of a medium uptrend. That is an important perspective to understand. The bulls have work to do. $92 is the level that separates a corrective bounce from a resumption of the bull market. Until silver clears that level, the bears can still make an argument that this is just a dead cat bounce within a larger correction. I am not saying that is my view. I am saying that is the technical reality we need to acknowledge. For those of you watching who are new to technical analysis, let me explain why these levels matter. Fibonacci retracement levels are based on mathematical ratios that appear throughout nature and financial markets. When a market pulls back from a high, it tends to find support and resistance at predictable percentage levels of that move. The 23.6% level is the shallowest retracement. The 38.2% is a moderate retracement. The 50% is a halfway point. And the 61.8% is a deep retracement. Silver bouncing off the lows and breaking above the 23.6% level is bullish. But until it clears the 38.2 and 50% levels, the move is technically still a retracement, not a resumption of the uptrend. That is the nuance. That is what the professionals are watching. And now you understand it too. Now let me address something that I think is really important. HSBC Asset Management just released commentary on gold and silver that I want to share with you because it presents a different perspective that we need to consider. They said this year's gold and silver price moves have been incredible. I agree. They said the rally was ignited by geopolitical tensions and fears over Fed independence. I agree with that too. But then they said something that made me pause. They said the 2025 rally mutated into a retail-led speculative frenzy, and a correction looked increasingly likely. That is worth thinking about. HSBC is asking where this leaves investors who have looked to gold as a portfolio diversifier. Their point is that while retail flows have boosted returns, they have also introduced equity-like volatility. And that equity-like volatility is anathema to a safe haven. When gold moves 30% in a few weeks, when silver crashes 31% in a single day, that is not safe haven behavior. That is speculative asset behavior. And for investors who bought gold specifically for portfolio diversification and stability, that volatility is concerning. But here is where HSBC's conclusion gets interesting. They said recent volatility tells us that no single safe haven is flawless. That is true. But their recommendation is not to abandon gold. Their recommendation is to diversify the diversifiers. Adopt an active multi-asset approach to capture uncorrelated performance across a broad spectrum of assets. In other words, gold still has a role, silver still has a role, but they should be part of a broader portfolio strategy, not the entire strategy. That is prudent advice regardless of whether you are bullish or bearish on precious metals. And HSBC made one more point that is critical. They said, central bank de-dollarization and crisis demand still underpin a structural case for precious metals. Let me repeat that. Central bank de-dollarization and crisis demand still underpin a structural case for precious metals. The long-term thesis is intact. China buying gold for 15 consecutive months is de-dollarization. Central banks around the world reducing their dollar reserves and increasing their gold reserves is de-dollarization. And crisis demand, the flight to safety when geopolitical tensions rise or financial systems come under stress, that demand is not going away. The structural case for gold and silver remains even if short-term volatility is higher than historical norms. Now I want to hear from you again. Where do you come down on this? Do you see gold and silver as portfolio diversifiers that should be held in moderation as part of a broader strategy? Or do you see them as primary holdings that deserve significant allocation given the macro environment we are in? Drop your thoughts in the comments. There is no right or wrong answer here. It depends on your personal situation, your risk tolerance, your time horizon, and your view of where the world is heading. But I want to hear from you because this community is smart and your perspectives help everyone, including me. Let me give you the price action from the Indian markets because it confirms what we are seeing globally. MCX Gold February futures jumped 1.31% to rupees 1,57,484 per 10 grams. MCX Silver March futures climbed 4.81% to rupees 2,61,900 per kilogram. Earlier in the day, silver had jumped as much as 6% to its day high before profit booking kicked in. That is the pattern we are seeing everywhere. Sharp rallies followed by some profit taking followed by another leg higher. The buyers are in control, but they are not chasing. They are letting the market come to them and buying the dips. Now let me connect all of this to the bigger picture because I think it is important to zoom out. Last week we saw extreme volatility. Silver crashed 31% in a single day. CME hiked margins twice in 72 hours. There was forced liquidation across the board. Fear spiked. And a lot of people thought the bull market was over. But what happened? Gold held above 5,000 after briefly dipping below. Silver bounced from $64 back to 82. The dollar broke down to its lowest level since February 4th. Central bank buying continued. ETF inflows remained strong, and bargain hunters stepped in to buy the dip. This is not the behavior of a market that is rolling over. This is the behavior of a market that is being accumulated on every pullback. And that is the key difference between a bull market correction and a bear market beginning. In a bull market correction, buyers emerge at lower levels. They absorb the selling, they rebuild the base, and eventually the uptrend resumes. In a bear market, every bounce gets sold. There are no committed buyers, the rallies fail, and the lows get lower. We are seeing the former right now. Every dip is being bought. The rallies are holding. The base is being rebuilt. Until that pattern changes, the bull market is intact. Now let me talk about what I am watching for the rest of this week because the next few days are critical. The employment data is the big one. Any softness in the jobs data helps gold. Any strength in the jobs data could temporarily boost the dollar and create headwinds for metals. That is the binary setup. I am not predicting what the number will be. Nobody knows until the data is released. But I am telling you what to watch for and how to interpret it when it comes out. If jobs come in weak, expect gold to rally and the dollar to fall further. The rate cut timeline accelerates. June becomes more certain. Maybe they even start pricing in additional cuts beyond the 2 currently expected. That would be the bullish scenario for precious metals. If jobs come in strong, expect a dollar bounce. Gold could pull back temporarily. The rate cut timeline gets pushed back. June becomes less certain. But here is the thing. One strong jobs report does not change the secular trend. The Fed has already signaled they are biased toward cutting. Mary Daly already said 1 or 2 more cuts are needed. The direction is clear even if the timing varies. So any pullback on strong data would likely be another buying opportunity for those with a longer time horizon. The inflation data on Friday is the other major event. If CPI comes in hot, that complicates the Fed's job. They want to cut rates to support the labor market, but they cannot ignore rising inflation. That uncertainty could actually be bullish for gold because it creates doubt about Fed policy, and doubt drives safe haven demand. If CPI comes in cool, that gives the Fed cover to cut aggressively. Lower inflation plus a weakening labor market equals rate cuts, and rate cuts equal higher gold prices. So either way, the path seems to lead back to the same destination. It is just a question of how we get there. Let me give you the key levels to watch for both metals. Gold needs to hold above 5,000. That is the psychological level that everyone is watching. We just reclaimed it. We need to defend it. A daily close below 5,000 would raise some short-term concerns. But as long as we hold above that level, the bulls are in control. For silver, watch the $80 level as support. If silver holds above 80, that is bullish. The next resistance is the 86.25 to 86.30 confluence zone I mentioned earlier. If silver can break above that zone and hold, 92 becomes the next target. But if silver gets rejected at 86.30, we could see a retest of the low 80s or even the high 70s before the next attempt higher. Now, for those of you who have been watching but have not subscribed yet, let me ask you something. Has this content helped you understand what is happening in the precious metals market? Has seeing both sides of the trade helped you make better decisions? If so, consider hitting that subscribe button. I know a lot of you watching right now are not subscribed. That is fine. I do not chase vanity metrics. But if this content adds value to your process, subscribing is how we grow this community. It tells the algorithm that this content is worth showing to more people, and it helps us build something based on substance rather than hype. So if you find value here, consider subscribing. If not, no hard feelings. I will keep doing what I do regardless. Here are your key takeaways, and we are out. First, gold is holding above $5,000 for the second consecutive session. The dollar has fallen to its lowest level since February 4th, and that weakness is directly supporting precious metals prices. Bargain hunters are stepping in to buy the dip after last week's volatility. The technical picture is stabilizing and the buyers are back in control. The Japanese election over the weekend strengthened the yen and contributed to dollar weakness. Currency dynamics are aligning in favor of precious metals right now. Second, silver is up for the second consecutive day and has broken above the 23.6% Fibonacci retracement level. That is a bullish technical signal. The MACD is positive with the histogram widening. The RSI is neutral at 50.63 with room to run higher. Key resistance is at the 86.25 to 86.30 confluence zone. If silver can break above that level, 92.95 becomes the next target. But until that happens, the bears can still argue this is just a corrective bounce. Watch those levels closely. Third, the Fed is signaling more rate cuts ahead. San Francisco Fed President Mary Daly said 1 or 2 more cuts may be needed to counteract labor market weakness. The market is pricing in at least 225 basis point cuts in 2026, with the first expected in June. The employment data this week is critical. Any softness in jobs helps gold. Any strength could temporarily support the dollar. But the secular trend is toward accommodation, and that is bullish for precious metals over the medium term. Fourth, HSBC warns that retail flows have introduced equity like volatility to gold and silver. The diversifier role is being challenged by these sharp moves, but they also confirm that central bank de-dollarization and crisis demand still underpin a structural case for precious metals. The long-term thesis is intact even if short-term volatility is higher than normal. Consider diversifying your diversifiers, but do not abandon the precious metals thesis. The unresolved tension is this. Gold has reclaimed 5,000. Silver is bouncing. The dollar is breaking down. The technicals are turning bullish. But we have major economic data coming this week that could shift the narrative. Employment data, inflation data, Fed speakers. Any of these could create short-term volatility. The question is whether the current strength can be sustained through the data releases or whether we see another pullback before the next leg higher. I do not know the answer. Nobody does. But I know what to watch, and now you do too. The setup is bullish, but the path is uncertain. That is always the case in markets. The bulls need to defend 5,000 in gold. The bulls need to break 86.30 in silver. If those things happen, the uptrend accelerates. If they do not, we continue to consolidate and build a base for the eventual breakout. Either way, the fundamental thesis has not changed. China is still buying. India is still buying. Central banks are still accumulating. The Fed is still biased toward cutting. The dollar is still weakening. Those are the facts. Everything else is noise. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frames. Are you trading on an hourly chart or investing on a yearly thesis? Plan and position accordingly. If you are over-leveraged, this volatility will destroy you regardless of whether the long-term thesis is correct. Position sizing matters. Risk management matters. Do not let greed or fear make your decisions for you. Use logic, use data, and make your own choices. I want to end with something one of you commented on a previous video. You said this channel helps you see through the noise and focus on what actually matters. That meant a lot to me because that is exactly what I am trying to do. The financial media is filled with hype, filled with fear, filled with people trying to sell you something. I am trying to do something different, just the data. Both sides, let you decide. If that resonates with you, we are going to get along just fine. Drop your thoughts in the comments. Let me know where you are watching from. Let me know what you think happens next for gold and silver. Let me know if the technical levels I outlined are helpful or if you want me to cover something different. This is a community, and your feedback shapes the content. The more you engage, the better this gets for everyone. But I could be wrong. I am not infallible. I am just one person looking at the same data everyone else has access to. The difference is I try to present it honestly without an agenda, without trying to sell you something, without trying to scare you or hype you. Just the facts. Both sides. Let you decide. And on that note, I will leave you with this. The next few days are important. Pay attention. Watch the data. Do not make emotional decisions. Have a plan before the data comes out so you know how you will react regardless of what the numbers show. That is how professionals approach markets. They do not react. They prepare. They have a playbook for every scenario. And when the scenario unfolds, they execute the plan without emotion. If jobs are weak, what will you do? If jobs are strong, what will you do? If gold breaks below 5,000, what will you do? If silver breaks above 86.30, what will you do? Have those answers before the events occur. That is the edge, not prediction, preparation. With John A.G., out and about.